Well, good evening, everybody, and thank you for your latitude in giving me the afternoon off so I could take care of some personal responsibilities this afternoon. I see a lot of wonderful names. There are definitely some people here that aren't normally with us during our Tuesday afternoon sessions that we've been doing now for several months. So this is a special holiday edition. Curl up by the fireplace and welcome. My name is Mark Robertson. I am joined here tonight by my dear friend Ken Kavula. Ken, say hello.
I'm saying hello to everybody, wishing everybody a Merry Christmas, a Happy New Year, and reminding everybody that a week from tonight, we will be running our annual December roundtable session. It starts at 8:30, so it's the same general time frame. So if you haven't already signed up to join us at the roundtable next week, Tuesday, by all means, go to the Mid-Michigan site on the Better Investing website and sign up, or drop me an email, kkavula1@comcast.net, or drop my wife an email, nkavula1@comcast.net, and we'll help you get registered for that roundtable in just a week.
And that's such a wonderful segue into our first slide here in a second. The roundtable has been quite a good thing here over the last few years. In fact, they kind of knocked my socks off earlier this morning. But for now, we just want to give a nod to anybody who's been affiliated with investment clubs, or if you're an individual investor involved with this community, we do regard it as one big investment club. This session was inspired by principally one investment club, but it's actually a combination or a composite of two or three investment clubs that Ken and I have spent time with. And we may actually see a part three. We're going to go as far as we can, much like Ken warned you a week ago. We weren't going to get through all 20 questions a week ago. I'm not sure we'll get through them tonight. We're just going to do the best we can, take and discuss them to the audience's satisfaction. But again, it's something that was inspired by that show, Love American Style. Some of you probably remember it was a TV show that was on in the proximity of Fantasy Island back in the, I believe, 1969, 1970 time frame. I'm showing my age a little bit, but I was pretty young back in those days.
We all were much younger back in those days.
It was a different time, but I will say I do remember the end of the 1960s. Can you say that, Ken?
Oh, I was in college at the end of the 1960s, Mark. I remember vividly a lot of what was going on.
Even with your founding of a fraternity and the things that you promoted and all that stuff, huh?
It was a good time to be alive in a small town in southern Ohio, and learned a lot. Had made a lot of good friends, and I would go back there in a moment if I could keep my same nest egg right now and deal with people that I know and keep them with me as I move back. But it was a great time.
Yeah, and Natalie's been a big part of that journey too.
Absolutely.
All right, so let's go ahead and get underway. You guys all know the official boilerplate paperwork here. No investment recommendation is intended. This is about the education associated with demonstrating the methods and techniques, the philosophies, basically the lessons learned over the last 80 years in the modern investment club movement, whether it's by the National Association of Investors, now known as Better Investing, or the interpretations of that method by us at Manifest Investing. It's all about coming together, sharing ideas, and learning and discovering actionable ideas and opportunities. That's really what we do. Ken was just talking about the roundtable. Again, the reminder is there. He mentioned nkavula1@comcast.net if you'd like a reminder. If you'd like copies of these slides, or if you have follow-up questions, we do have a number of follow-up questions, which we'll probably take on the epilogue or the continuation of this meeting a week from today. All right. Just a reminder, we do like the mural up at the top of the Bulls Gathered, and we believe in the lessons of George Nicholson and the modern investment club movement. And this is just a reminder that we get together on Tuesday afternoons for informal versions of this and talk about a variety of subjects. Some of them that are in the bullpen are listed there. If you have a topic that you'd like to see us cover, drop either Ken or myself an email, and we would love to explore it during a future session. All right, for now, we started here last week, and then true to form, you guys, a number of you came to us with a question, and since I can't start a session on question number 13 is where we left off, we're going to actually start with question 1B. And Ken liked this one earlier this morning. Let's go ahead and jump up to 1B. Here's that same graphic. And we're going to start tonight's session in virtually the same place, only with an addition. And the question is basically a bunch of performance statistics and just basically asking about a number of portfolios and rates of return and that sort of thing. We'll go through them here in a second. And somebody came along and added, what about the investing roundtable? Again, that roundtable is next Tuesday night, Tuesday evening. And the first point I want to make is anytime that you're talking about making performance comparisons, you have to do one of two things. You have to either put them on the same time frame footing, and then you can compare absolute rates of return, or you have to compute relative returns. In this case, I chose to compare identical 5-year periods. And you guys came back and said, well, what about the investing roundtable? And this really warmed my morning coffee. I think it probably did okay on your end too, Ken, right?
I felt real good when you sent me this number, Mark, I'll tell you.
Because you guys asked for it, here it is. And starting with the lowest bar on this chart, that's basically the Dalbar representation of average investors. Now, nobody here is an average investor. That's a performance chasing, day trading type, hair on fire investor that's doesn't really deserve the term investor associated with them. Chasing performance, chasing the hot stock tips, that sort of thing, they turn in this type of performance. The stock market, as measured by the value line arithmetic average, checks in at about 10% over the last 5 years. That's the value line arithmetic average there. That's the 1,700 companies in the standard edition. And we use the Wilshire 5000 for the general stock market. Notice that does check in the 15% range, largely aided and abetted by the Microsofts, Apples, Facebooks, Googles, etc. Those type of companies that basically make up the top 10 companies, I believe, in the Wilshire 5000 account for 20 or 30% of the total performance of that index. So it is market cap weighted. Notice that the Better Investing 100, that's the top 100 companies held by investment clubs, comes in at about Wilshire 5000 levels. So that's, again, an unmanaged index, but it is an indication of what is actually held by investment clubs. Then, of course, we love the fact that our tin cup model portfolio over the last 5 years checks in at 17-ish%. And the one that really kind of surprised me, Ken, was the Manifest 40, checking in at the highest, at least until this morning, on this chart. And then you guys asked the question, well, how has the roundtable actually done if you take a look at just the last 5 years? And this one kind of took our breath away. It's always kind of fun to start the day like that, isn't it, Ken?
Absolutely.
That's 20.
I agree.
There she is, ka-ching. Welcome, Kim.
Thank you.
I mean, that's a good one, 22.2%. We have been on a pretty good tear, knocking on wood, hoping that the trend continues. But that's a lot of fun. If that's not enough motivation to come next Tuesday night, I'm not sure I can help you. All right, but then in the italics here, I want to draw your attention to this. Again, I served on the Better Investing staff, on the magazine staff, and the question which came from an investment club basically was challenging manifest investing as something different. Two investing approaches. And I would argue that it's not. It's basically an extrapolation of the investment club techniques and methods. And, why do we think that why do we think this is happening? Why do we see Tin Cup doing this well? The widely followed stocks in the Manifest 40. And then, of course, the Roundtable, which is even better because that is Manifest investing influenced, but it is definitely a team effort. With independent selections, we very rarely, and I mean really rarely, ever really compare notes before we get together and present them to you guys. I don't see it as two investing approaches. It's just, again, as I said, an extrapolation. The one thing that we do that's a little bit different, we place more emphasis on and we'll cover this in a minute, more emphasis on the forward-looking estimates. And we embed them in our imagination, our depiction, our vision for a company. And for more on that subject, I would direct you to this URL at the bottom of the page. It's the inspiration behind Dead Poet Society and Robin Williams, but this Oh Captain, My Captain, where we basically go through and describe why we think it's imperative to really embed the forward-looking estimates, be mindful of the forward-looking estimates for companies in our study of companies. And the only other thing, and that's going to come up in great detail here in a few minutes, is a much higher emphasis on the best small companies. And I think those are probably the two main influences that are causing what we're seeing in the pretty picture. Ken, your thoughts?
Well, yeah, Mark, I'd like to believe that if we were creating the association of investment clubs today, that we would take full advantage of all the data that was available, all the tools that were available, the power of the computer to bring data to our fingertips, as good as the data being brought to almost any other analyst that you can pinpoint. And I think that's the one thing that has kind of pushed us just a little bit, especially in the last 10 years. And that's when we come up with a good idea that's data driven and that maybe would have been extremely difficult to deal with in the 40s or the 50s when better investing was getting its feet wet and getting its philosophy grounded. I think that we're suggesting that by looking at data, by keeping our eyes open and our minds open, that there are holes in what better investing has always suggested we do, and we can plug some of those holes. I remember, and some of our audience remembers, putting together SSGs by hand with colored pencils and all of the effort that went into a single SSG, and the reluctance that there was in the 70s and early 80s, the reluctance to alter the SSG or to compare two or three different companies, because it just took so much darn time to gather the information and get it onto that chart. Today we can do all that stuff, and therefore we do it. And I think that's the kind of thing that contributes to better return in the long run.
Yeah, and I guess I would underscore, we at Manifest Investing believe that the two most important characteristics of any investment are the return forecast. You guys would recognize that as the PAR from Section 5, and the quality of the company. And you don't have to compromise on those for the best small companies. That's probably one of the major things that we've discovered. The techniques and methods that Nicholson gave us can be extrapolated into finding the best small companies that have up, straight, and parallel. And that's a relatively new phenomenon. But the emphasis on being results driven, focused on the outcome, focused on the return forecast. We're going to spend some time on that tonight, but that is an essential part of it. All right, so let's go ahead and crunch through some of these questions. Again, inspired by discussions with investment clubs. And again, they just wanted to make sure they understand, in this case, that the sales growth forecast in one of our stock studies is a 5-year forecast. And the situation at Manifest anyhow is that it's always 5 years. We're always looking out 5 years. And this is a little bit of a misnomer here, because it's not necessarily tied to the 5-year thing. The sales growth forecast is the slope of the long-term sales trend. And like we were just talking about it's historical data from 2010 to 2019, but these are analyst estimates for those 3 years. And out here, this is from Value Line. That's a 3 to 5 year estimate for Value Line. So these numbers that are circled here are estimates. Again, analyst consensus estimates. We happen to derive our data from Y charts on a continuous basis. It changes daily. So we're constantly watching this picture, across 2,400 companies. And what we're watching for are deflections in that red dotted line. Again, that's the long-term sales trend. And we are definitely always mindful of this 5-year type window. Anything you'd like to add?
And Mark, and when you're not looking at a beautiful sales line like this one happens to be, whatever this company is, when you're not looking at a line like that, when you're looking at a sales line where 2020 has dropped off a cliff, perhaps, and 2021 is just beginning to recover in the estimates and everything, that's what makes the analysis conform a little bit more to what reality probably is going to end up being. We know that we have some really terrible numbers for a lot of companies coming at the end of 2020, at the end of the fiscal year. And we know that if we are patient and get by 2020 and maybe 2021, that those numbers are going to appear to be more and more like the dreaded outlier. And therefore, we have to depend on this long history. That red line goes all the way back to 2010. And we have to be aware that that goes forward 5 years into the future. That will allow us to come up with some projections that maybe don't waggle as much as the actual analysts wiggle waggle. And therefore, that would mean, in my mind, that we don't go above the projections so much when things are going well, and we don't become so pessimistic when things are going not so well that our projections get way out of line to what probably and in a lot of cases actually does happen.
So Ken, you used a highly technical term there, wiggle waggle.
Yes, that was the best choice of words, I think.
I guess I got to ask, have you ever seen a rhino wiggle waggle? So,
well, no, I think they're just closing their eyes and running. Okay, but that means that once they decide on their target, they're moving full steam ahead towards whatever that target is. And whether that target is 20 points to the left or 20 points to the right, maybe we should think of it as above or below what the actual target should be. They're ready to run in that direction until somebody says that the direction needs to be changed a little bit.
Well, I'm going to give out some homework, because what Ken is basically describing is, what if 2020 came in here and we're expected to come in down here for 2021, and then a few weeks later or a few months later, the analysts come back and say, oh, no, it's going to be up here. That's wiggling and waggling. And I'm going to give you the homework of just go ahead and search on use the search box on, you can even do it with Google, but Ken and I have spent a lot of time talking about chasms. And if you just simply go into Manifest and use the search box up at the top of the page and search on the word chasm, you can find a number of discussions about when things get really turbulent like this, like we've seen from COVID right now. So again, I thought we were going to spend a minute on this slide, and look, we've done more than that, Ken.
I was taken to task, Mark, by my brighter half the last time we spoke of chasms, when she suggested that we better not ever say chasm, because then we appear to be really, really stupid. Okay, so
Did
it's
I
chasm,
did,
chasm
did
from
I say
now on.
chasm?
Okay, we both did at the last session. So
Oh, we
we
did
gotta,
not.
we have to. Yes, we did. We have to be very careful. It's
I have to
chasm.
go back and
Okay.
I have to go back and edit the tape. Kim, what's on your mind?
Well, the only thing I was going to say is one of the things that we all need to remember when we have, I'll say, volatility in the market, is when we have companies who've got outstanding management and they consistently can give us great return on invested capital, even when the stock price goes down, that's kind of like when I get excited rubbing my hands together because, woo, okay, I'm getting a bargain now. Because I know that management team, no matter what's thrown to them, they're going to be able to get through whatever issue is out there.
And come out
But
the
that
other side.
volatility in the market pushing the stock price down, those are those kind of companies I love having on my pounce list.
So excellent management will prevail when things calm down, is what it comes down to.
Yep.
All right. All right, let's go to this one. Question number 14. Are there any additional metrics that should be used to analyze bank stocks? And then we can go through and talk about a variety of different things. And Ken will be tempted to use total assets. We could talk a little bit about that, but I think we want to table that pretty much. What I want to share and confess is I've been doing this now for close to 30 years. And over 20 years ago, over 25 years ago, I made the decision that I was going to do it like Buffett. And what I mean by that is I substitute book value, not total assets, but book value per share instead of sales on a stock selection guide. I've done this now, like I said, for over 25 years. We're going to take a closer look at in the next series of slides at whether or not that makes sense and whether or not it can generate comparable results. Because some of you, Ken was just talking about doing stock studies, stock selection guides with multiple colored pencils. I can remember actually walking through the 9 different ways, the 9 different data point pieces on a financial company in value line. And that's how much of a difference there can be in, how you could actually build a sales line, that sort of thing. The takeaway that I want you to take away from now, and we're going to look at this a little bit closer, is at Manifest Investing for any asset-based company. That's a bank or an insurance company, that type of a company, some asset managers, that sort of thing, where their mission in life as a company is to build a huge pile of money and then basically extract a management fee, a percentage from that pile of money. So we don't apply this to industrial companies. We apply it to asset-based companies, and you can read the text there yourself. But that's what we're going to talk about. Ken, your thoughts?
Well, again, Mark, if we have data available and somebody's calculating for us, I'm ready to use it, especially if there's interpretation behind it. I don't have much problem with using book value or using total assets as a proxy for sales. And in fact, I think they both work fairly well as that proxy. What I really like is this new number that's coming up on banks if I'm using better investing data, and that's the return on average assets. And since I'm getting a benchmark number for what's average and what's good and what's superior, that's helping me decide on the quality of a bank. And as you just said, quality is one of the 2 things that I'm after on a regular basis. And when I'm looking at a bank, return on average assets certainly plays into that idea of quality.
Absolutely. In fact, I wrote an article about it back around 1997. I should dig that up, where I used return on assets. And Another secret for you guys, Don Danko used to be a bank analyst before he became editor of Better Investing Magazine. And that was his, when we would come back from our stock selection meetings for Better Investing Magazine, that was exactly what he used, was total assets, return on assets to do a bank. So it's been out there for a while. Now, this particular investment club was really wrestling with my approach of dealing with asset-based companies. So what we did is we took Aflac, the company Aflac, ticker symbol AFL. We all know the company quite well. And we did a side-by-side comparison of them as an industrial company. Again, this is the traditional thing that we would have been studying over the years at Better Investing, building a sales profile, looking at margins, all that sort of stuff. And we're going to compare them side by side versus our asset-based approach where we use book value. Again, the book value here for Aflac and return on equity instead of sales and net margins. And what I want to walk you through is how the company compares using those two approaches. So let's start with the comparison of the characteristic of Aflac. And if you look at Aflac over the years, I think many of us are aware of the apparent stagnation when it comes to top line sales at Aflac. I don't know if they've reached some type of a demographic barrier or whatever the real story is behind some of that, but there are many Aflac shareholders among us, and it's a company with basically a very flat, if not slightly negative, top line growth characteristic as shown by that trend. If, on the other hand, you look at book value, this is a company that is well managed. They do manage their capital structure well. They invest well, and the book value, even in this land of, or this long-term trend of relatively flat top line sales, they have been managing the book value quite well. So two fairly dramatically different pictures, and of course the earnings are the same for the two side by side. So if you want to dig in a little bit deeper to this, again, I'm going to direct you to this link down at the bottom. In the Manifest Investing Forum, we actually walk through all of this if you want more on this after the session. All right, any thoughts, Ken, or should I just keep rolling?
Keep rolling, Mark.
All right, so here's how we look at the two side by side. Again, treating it as an industrial company, you would be looking at the net margin or the pre-tax margin, some form of profitability as measured by a margin characteristic. And notice that even though their sales have been relatively flat, their profitability has been steadily improving. Nice. And in fact, their return on equity, because the total amount of shareholder equity in the company has been steadily increasing, this is still a really nice number, but it's actually been maturing. And it's ending up somewhere in that 10 to mid-teens situation. Still very good, but it has been, quote unquote, maturing. Of course, the PE ratio, independent of what method you select here, has been actually fairly steady. Here's some of that chasm disruption back from a couple years ago, and there was another one back here. But the PE has been disrupted from time to time. All right. And then let's go ahead and finish it out, because that's what this investment club was basically saying is, can we trust, our traditional industrial-based approach using sales and profitability as measured by net margin to calculate, again, the PE ratios here. So the Section 5 projected annual return checks in at 21.5%. Using the book value at 36.5 with the superior growth characteristics, slightly lower return on equity, same PE, I would argue that those are the same number. And this was just picked out of the air. It wasn't picked to, much like a magician picking somebody out of the audience to make his point for him. We just picked it out and said, what does it look like? This is more commonly the case with a company like Aflac, that they do match up fairly well. then that's why I have basically used this asset-based approach for my personal investing efforts for over 25 years. It's simpler. It's simpler, and I would argue it's probably less vulnerable to some nasty stuff and gyrations. I also want you to notice the projected return on capital, something we'll talk about in greater detail later, also checks out as pretty comparable. So again, the topic is there. My argument is it generates a very comparable, very representative result, and it's actually easier.
Mark, we're getting a question. Would you consider Air Lease an asset-based company?
I think for Air Lease, it would be great to run these side by side. I think we have Air Lease in asset-based. I'd have to look. We're pretty much treating Air Lease as a financial company.
Because the one thing it's very hard is you have to remember Air Lease has lots of debt, but because they are a company on doing leasing, they're kind of like, as you say, Mark, they're an asset based, and they've been, yeah, full disclosure, it's in my investment club, and when it was it last year at this time when it had a pullback, because I think the stock was at like 45, we put in a Hail Mary. Okay, if it gets to, I think it was, if we got to 32, we were going to buy more shares, and we ended up getting it. We just felt that the management of Air Lease has such experience on it, what to do. We felt comfortable if it did pull back in price to buy some more.
Well, I don't remember whether it was in the first batch of questions. We talked about Air Lease fairly extensively. It's either in the slides ahead of us or in the ones behind us. If it's not ahead of us, we can perhaps come back to that, because we talked about Air Lease and the plateau in the stock price and that sort of thing. I'm pretty sure previously. We'll go back and grab that.
Mark, we're getting some pushback on that slide right there.
Okay.
Can you walk people down to the 21.5% industrial model? People are having a hard time understanding how sales growth can be 0% and yet par can be above 20.
Oh yeah, I get that too. Yeah, it basically is what it is. You were talking about a company with $22 billion in current sales. So that means that the 5-year forecast using a growth rate of 0 is 22 billion, right? So 22 billion times a projected net margin of 15% gives you a net income of a little over 3 billion. Okay, and 3 billion divided by 600 shares outstanding roughly takes you to a PE forecast of $5 a share. And again, that's not impossible to imagine looking at this picture right here. I mean, right here you are looking at $5 a share in earnings. It's not impossible to imagine that, just looking at that graphic. If it's $5 a share with a PE of 15, you're talking about a future price of $76. Okay, so the current price back, again, this was right immediately following the COVID disruption. The bottom of the market actually was in late March. This happens to be mid-May, but the stock price was still down at 32. So from 32 to 64, 32 to 76, that's obviously more than 15%. That's more than double over a 5-year period. It happens to be 18, 19%. They are paying a handsome dividend, 2.5%. So you can get to a 20% annualized return. You're basically talking about a textbook value situation, the way that the rhinos look at companies like this. So I know it can be a little bit challenging to think about, but again, think back to what we've told you all along. The return forecast and the growth are two different things. They're two different things. And you want to make sure you think about them that way. And this is a kind of a special situation because of the COVID disruption. Now, I don't know if that helps, Ken, but
well, I think we should hammer into the audience the fact that this is not today's prices. This is happening back in May, and you'd have to redo all this arithmetic for today's prices. And I think Aflac is trading a little bit better than 32.13 right now.
yeah, I'm not sure where it's at, but it's probably recovered into the 50s or 60s, I would guess. So
yeah, that was my snide comment that it's much better than 32.13 at the moment.
Which means that the return forecast is now probably single digits. So the opportunity to load up on Aflac was in the 2020 hindsight of a rearview mirror a few months ago.
Len is telling us that the current price is 42.40, so it's gone up about 33%.
Right, which takes away some of the long-term potential. All right, does that help any better or not, you think?
I'm not sure that it sits well with a few of these folks, but I think they need to sit in and think this through because the arithmetic doesn't lie.
Yep. All right, let's go ahead and press on. Question number 16. This is just a simple process question. And I have a confession. Pete, I know you guys, a lot of you print a lot of stuff. And every once in a while, some of the printing parameters get jumbled and it causes problems. I get that. My confession is that I print so little stuff, I'm the wrong person to ask this question. I mean, I really do print almost nothing. What I do all the time is what you're seeing right here is capture screen captures, and there's a whole bunch of different types of screen capture software, and post them either in Word documents or PowerPoints actually is friendlier from my experience. But and then you can distribute a PDF for people who want paper. But the point that I have to make is I'm pretty much a one-man show. Kurt is part-time, and Ken is a volunteer. Kim is a volunteer at Manifest, and there would be an infinite number of combinations to chase when you come down to browser settings, printer settings, multiple printers, all that kind of stuff. I was on the phone the other day with a guy who was using 3 different browsers and 3 different printers. That's beyond my pay grade to understand all of that stuff. So I'm just saying, please understand, I will try to figure out if we are losing something the next time Kurt is looking at the site refresh that he's doing. But that's all we can do at this point. All right, question 17. The Manifest investing site provides plots of the return forecast or par over time. Can a tabular record of historical par be downloaded? Par is a function of time. Can the time scale be changed? Yeah, we can do that stuff. It's all a manual custom effort. We sometimes will dive in and attack a subject. This particular slide is from some design work that we have done, but it was specifically done to take a closer look at Cognizant. And some of you may remember Ken and I did a series on Cognizant a couple of years ago now. And we wanted to take a closer look at what had happened to the company over a longer time than a traditional chronicle. So yeah, if you've got a company you think that we can really grab and take a look at, again, this shows you that sometimes elusive relationship between the price and the return forecast or par. I would argue that this was a really nice time to buy Cognizant 10 years ago. Look at these return forecasts. And that would have made you smile 10 years later for darn sure. Your thoughts on this one, Ken?
Well, I don't want to offend anybody in our audience, but sometimes I think people are asking for things that why they'd be nice to have. You wouldn't ask of any other commercial website where you didn't know the guy that was running the whole thing. I really think that there's enough information on a lot of these things, and because you'd like to read it in a slightly different form doesn't mean it's something that can happen, or it doesn't mean that it's something that really should happen. I would suggest, just as Mark said before, that maybe it's better just to capture what's there on a screen capture of some sort. There's a lot of good screen capture programs out there. Slap it onto a Word document or a PowerPoint document, and then print it to your heart's content based on the limitations that Microsoft gives you in some of those kind of documents. You'll quickly find out that Mark is much more responsive than Microsoft or Google or any of the other commercial sources that you might want to choose to use.
Yeah, and like we've been saying, I mean, this was a really neat way to look at Cognizant. Ken often during his roundtable presentations talks about, watching for multi-year highs when it comes to the return forecast. If you had decided, as Cy probably did, to accumulate Cognizant at those moments, it turned out to be a pretty good decision. I think as you look at chronicles on company after company, you see that type of relationship quite often. There are times when that's not the case, but those are more the exception than the rule from my experience. So yeah, we can do more of that. I will warn you that some of that can be fairly time consuming. I just updated the Apple Chronicle this week, and for the 4-for-1 stock price split, because we missed it automatically, and that took me some time to do. All right.
And believe me, Mark, I appreciate the folks in the audience that agree that we just need to keep some of these things as simple as we possibly can. We don't have to make it harder if it's pretty self-explanatory to start with.
Very cool. Okay, I was kind of surprised by this question. This one actually came from more than one investment club. And Ken, this is like teeing it up on the softball, on the t-ball stand for you. What do we think about size diversification / growth diversification? Or does it not matter as much to us? So Ken, I'm just going to let you run with this one.
Well, it absolutely matters, but I think that we get lost in this vocabulary sometimes of capitalization, and our investing colleagues in the analyst world tend to talk about capitalization all the time, and capitalization is about as far from what we're talking about when we're talking about sales growth as we can possibly get. We're talking about the fact that certain size companies, and sometimes the company acts as a small fish in a big pond, or a small fish in a small pond, or a big fish in a small pond, and we just have to kind of go with the flow. We're looking for a certain number of high growth companies in our portfolio. And when George Nicholson put a lot of this information together, he made it quite clear that about a quarter of your portfolio should be made up of these faster growing companies. I really wish he would never have used the word small, large, and medium, and that we would have used the word faster, slower, and medium growth companies, because we're looking for about a quarter faster growing companies and about a quarter slower growing companies, and about half the portfolio to be made up of these nice, steady workhorses. And we've set benchmarks for this kind of growth. We said, when you grow 7% or less, call yourself a slow grower. And when you grow 12% or more, call yourself a fast grower. And when you grow somewhere between 7 and 12%, call yourself a mid-range grower. Call yourself a workhorse. And that's what we're talking about in this type of diversification. It has nothing to do with sectors. It has nothing to do with capitalization. It has to do with the fact that we want to balance the growth of our companies. We don't want all slow growers for the obvious reason we'll never hit targets that are aggressive. And we don't want all fast growers because that puts us in a situation where we're a little bit less stable than we'd like to be for a portfolio that we're going to try to look forward at in 5 years. So whatever you want to call it, just focus on the fact that we need these different sizes, these different types of growth in our portfolio for us to be successful and to hit these goals, which are quite aggressive. You know, the goal, beat the market by 5 points. That translates into 15% growth on an average year for your own portfolio or for an investment club portfolio.
Yeah, and if it feels like we're in a little bit of strange territory, this is from a Forbes survey from several years ago. We're actually saying that none of the above is the right answer for this one. So we're in a group of 3% or less of the people who talk about how do you characterize the size of a company. Again, from a portfolio design perspective, as an engineer, it's very important. And in fact, I would go so far as to say, based on our work over the last several years with the best small companies, and we've had a lot of fun with that. I actually, for my own personal investing efforts, am probably using 14% as a target. I try to find companies growing more along that range. The reason for that has to do with that list of the best, most successful institutional investment funds, and we'll actually be displaying some of that perhaps next week. We'll throw that out there again for you guys to see. The common characteristic that some of the best performing mutual funds and exchange traded funds out there, they have growth rates like this on average, and it's just something to keep in mind. Like I said, I was kind of surprised to hear this, especially from one of the clubs that we heard it from. We talk about all of the above investing all the time, and when we talk about all of the above investing, we're talking about investing in small, medium, and large companies. And I think this is one of the better slides that we put out there that makes the point. The blue line is the S&P 500 from basically the turn of the century, 1999 through 2019. And the black line is the value line arithmetic average. So the value line arithmetic average has outperformed the S&P 500 handily over the last 20 years. Now, the last year has been an exception. The value line last couple of years. The S&P 500, thanks to those Microsoft, all those companies up at the top, Apple, all doing so well, they've actually narrowed this gap in the last couple of years. But over the long term, again, keep in mind that all of these big mega companies that are in the S&P 500 are also in here. They're also in that black line. They're in there. So the thing that is actually propelling that black line up, it's equally weighted. So you've got a bunch of medium-sized workhorses and those smaller, faster-growing companies in the value line standard edition. And I just think that really makes the case for an opportunity to improve performance.
Yeah, Mark, I get a lot of feedback that we think the S&P 500 is a terrible index. Folks, this 20-year return here is around 200%. That's nothing to be sneezed at. And if that's what you can do, then I think more power to you. You're still putting together a sum of money that will serve you well as you age. But if you can turn 200% into 500% or 600% or 750%, shouldn't you at least think about changing from the S&P 500 to something that has a little bit more balance as far as sales growth is concerned?
Absolutely. And in fact, I was reading this morning an article I wrote about an interview I did with Santa back in December. 2009. So right here at this point in the chart, I basically said it was okay to invest in the S&P 500. So I think that was a pretty good call in my discussion with Santa from a little over 10 years ago. All right.
He's been rather jolly with us, and I'm not complaining.
No complaints. All right. Let's talk a little bit about portfolio design and management, and when to sell a little bit. Please explain how we select stocks. And I think what they're coming at, reading between the lines of this question, is what we refer to as the challenge or hot seat method, where we take a look at companies and make them candidates for selling considerations or debates. And we use a number of them. These are actually in practice at Tin Cup, at the roundtable tracking portfolio that we do. And some of these are very traditional and others are not quite so traditional. The first one is if you can make the portfolio better. We're going to cover that in greater detail. The vast majority of stuff that we talk about is what Nicholson called Rule 1, and Ken will cover it. Can you take and replace a company with a better situation and improve the overall portfolio? One of the other things that we watch for, particularly with the roundtable or some of the Fave 5 stocks, is if the relative strength index gets overbought. Overbought, according to the rhinos, is 70, and a relative strength index of 70 or more. We think that by going to 80, you take a little bit of, I think that was wiggle waggle out of it, Ken. Is that the right? And you don't get wiggled and waggled quite as much. And in fact, that was a major part. Well, maybe not major. It was part of that cognizant technology discussion from last summer that you can retrieve that session on YouTube. If the holding needs a Rule of 5 timeout, we're going to talk about that. It's one of my favorite things. And in fact, in that December 2015 roundtable archive recording, Ken, I talked quite a bit about that back in that time frame. That was before we had begun talking about the Rule of 5 aspect of it. Kind of interesting to go back and hear our thoughts forming and bubbling. And again, in an individual holding case, if it drops below the target return forecast, depending on whether a stock is core or non-core. One of the other things that I've run into this with a lot of clubs, and I'm not sure where the inspiration or genesis of the idea of it comes from. I know I've heard some speakers make presentations about some of the portfolio review techniques, and if you have 3 bad quarters in a row. I'm just going to say that I'm pretty well versed in a lot of the writings of Better Investing, and I don't think that stuff ever really applied. I don't think it's a Better Investing recommendation. In fact, it goes against much of what Nicholson believed, because if you haven't, as Kim was saying earlier, if you've got an excellent company that's had 3 bad quarters, maybe it works itself out more often than not if you have a truly excellent company. So
you can have an excellent company that just did a big acquisition, and to integrate the new company into the old one, it's going to have to shake out a few quarters before that's going to work. So they could have a drop in earnings and a drop in sales because they're getting all those different departments to work together. But overall, the management that's able to keep, and I always like looking at the return on invested capital, because that management team has got the great capital allocation. And I can think of a stock right now where the stock price is dropping, but you've got excellent management and great capital allocation skills, and they got big, fat, juicy margins, but the stock price is dropping. It's because I think, the markets is just doesn't know what's going to happen.
Yeah, I do think that the rhinos can get heebie-jeebies for any company, and again, it becomes a challenge to figure out the core of what's going on.
Mark, when I read question number 19, what I visualize is 1 or 2 guys in an investment club. It's usually guys, by the way. 1 or 2 guys in an investment club coming up with some kind of a checklist that if this happens and this happens and this happens, then we're going to, you know, sell, or we're going to buy, or we're going to take some specific action. And the sheet becomes quite complicated. The checklist becomes quite complicated. The collection of data becomes quite complicated. And pretty soon the goal of the club is to fill out the sheet. It has nothing to do with managing the portfolio anymore, but it's to get the darn sheet filled out. I would suggest that if you could take this skill, which is called investing, which I consider to have as much art attached to it as it does actual rules attached to it. If you can take this skill and turn it into something that's rules-based and will work all of the time, then you have a product you really want to sell to as many people as you could sell really quickly, because it's going to make a lot of people a lot of money. I would also suggest, however, that if an art could be turned into something that you could do a checklist on, then paint by number would give you beautiful things to hang on your wall as well. So I'm leery about when I start reading these kind of rules for any company at any time. Now, if you want to tell me that some of these things might hold true 30 or 40% of the time, and they're good indicators for you to start to do some deep dives into what's going on, I'd buy that. But the kind of exceptions that we talk about constantly in companies suggest that they're not really ready to have some kind of a checklist, which is going to tell us exactly when the right moment to sell happens.
Well, let's go ahead and move on, but I will annoy anybody who's still listening. A traditional growth company is going to experience this naturally at some point in its life cycle. So, I mean, almost any company out there is eligible for this treatment at some point during its wonderful life cycle. That's all I'm going to say. All right. And of course, I'm just going to leave you guys with this thought. We'll go on and talk about some of the selling things. I think we'll run a little bit longer than I can, but not too bad. A few months ago, we basically took a look at the answer to the question, applying these selling disciplines to the roundtable portfolio, which at the time had a rate of return of 16.1%. This was for our for the COVID cancellation conference earlier in the year. We now have an 18.5% rate of return, by the way. We asked the question, what if we hadn't done the selling disciplines that we've been mapping out and talking about? And Buy and Forget would have delivered an 11.8%. That's a substantial difference. So again, one of the other things I want everybody to think about is looking at the consequences and what happened with a single decision about a single holding can make you crazy. It's what it all adds up to in the long run that really matters. I would argue that some of the stuff that we're talking about here, 1 through 4, if it produces 4.3% more rate of return, we're doing something worthy. So, all right. Just a reminder, we have been talking about some of these selling concepts in greater detail. You can find selling presentations on the YouTube page and searching in the archives at Manifest, but it's something that we've been kicking around for quite a bit. So let's go ahead and just summarize them quickly and we'll be done for the evening, Ken. I know this is one of your favorites, so go ahead, Ken.
Well, I'm reading the 1984 edition of the NAIC Investors Manual, the first edition from '84, and it says Rule 1 will probably account for 90% of your sell transactions. Well, yippee, all I got to do is find Rule 1 and I'm all set then. Well, Rule 1 is down here at the bottom. Sell because an issue of equal quality offers more gain on the upside and apparently less risk on the downside. In other words, sell to make your portfolio better. There's no checklist here. There's no counting of quarters. There's no splitting of hairs and asking how many angels can dance on the head of a pin. It's just basic, simple, common sense. And Mr. Nicholson and the folks at NAIC said that this common sense approach to investing should account for 90% of your sell transactions. Now, that doesn't leave very many sell transactions for me. I mean, I probably make 4 or 5 sell transactions a year. And so if 90% of them are governed by Rule 1, then I don't have too much to worry about. And I can't mess the portfolio up in any great degree if I stick to making all of my sell transactions based on Rule 1.
I was chuckling because it took me a long time to find Rule 1 in the book. In fact, let's go ahead and use this slide to demonstrate Rule 1, Ken.
Easy enough, yeah. I know, I don't care if I like these stocks or I don't like these stocks. They might have great management, but if I'm reasonably confident that the par values are correct with a tolerance of plus or minus 3 or 4%, if I'm reasonably confident in those par values, then I'm also reasonably confident that I could find 3 stocks with similar quality that have par values 12, 15% higher than these par values. And if I can do that, then why not replace these 3 with the 3 others that I can find? My work should involve a constant challenging of the stocks in my portfolio with low pars and replacing them either with something that's not on the list or adding to the stocks that are already on the list that have pars that are widely enough differentiated from the low pars so that I'm reasonably certain, even with a tolerance value, that I'm going to do better. Now that means that I don't think that I'd want to replace any of those 3 with Pepsi. I mean, that 4.5% Pepsi par value, that might be very close to that 2.4% Ulta Beauty value. In fact, those 2 numbers might come close to being identical if I follow them for a reasonable period of time. But if I'm going to replace Ulta Beauty, I would look at Air Lease or Western Alliance Bank or Google, or for that matter, Regeneron or Facebook. This is a darn nice portfolio. The quality is really decent in every one of these stocks. And what I have to do, and this is where Mark was coming from 8 slides ago, is focus on what's important. And what is important is return and quality. That's what's important in a portfolio.
Yeah, and I would also point out that we were just talking about the importance of growth. This one's at 9%. If I'm in this investment club, I'm encouraging them to, look at some of these double-digit companies for growth because you're replacing some fairly mature companies, with faster-growing companies. Get this number up and get the return, the projected annual return number up. So that's the hot seat process. Challenge and audit the companies at the top and go to work on them. Let me spend just a minute talking about something that we now recognize as simply the rule of 5. I had nominated Iconic's brand group for the roundtable portfolio back sometime in 2015. So we invested $1,000 into it, came back a month later, and it was worth $800. And we talked about, how you buy something for $1,000 and now it's only $800. If you liked it at $1,000, you probably really like it at $800, right? We've all made that mistake. we had actually talked at that time about this notion of if a company lags the market by 20%, and there's a whole bunch of references on this I'll put them in the session notes where you can dig into this a little bit deeper. But we call this the rule of five, giving a company a timeout, a holding. If it's lagging the market by more than 20%, just calling timeout and walking away from it. And what I want you to notice that if we had done that with it at 800, and we did, by the way, for the roundtable tracking portfolio, walked away from it, even though it was the best stock study in the history of the roundtable. A few months before that, I want you to notice where this company proceeded to go after that. The last time I checked, and this is from obviously a few months ago, the last time I checked it was now worth $19. So that's how you protect yourself from, again, the rule of five is that there's going to be that one that misbehaves. Well, if the relative return performance flags it, take advantage of that situation. So dig in and understand that. And then I think we'll go ahead and close down with this final question, and we're going to actually tack on a few more in future sessions. Probably wrap up and dig in a little bit deeper, perhaps talk a little bit more about air lease, but it all comes down to how much weight should we place on the projected return when making decisions. And again, I believe that the strength of the stock selection guide really does reside in sections 1 and 2 and section 5. I'm not saying that there's anything terribly wrong with sections 3 and 4. It's just that the real strength of the stock selection guide is in 1, 2, and 5. And that combined with the preferred procedure approach to the business model analysis of companies is, again, one of those other attributes of Manifest that I think makes a big difference. So, I mean, the question from the club is, should we really care about these return forecasts? And my answer is absolutely. I think it is the best divining rod that we have. And it was just interesting to hear some of these type of questions. And the answer is I give it considerable emphasis. It's one of the primary, not the only, but one of the primary reasons, just as you heard Ken going over, for doing portfolio design and management. And it really is the bottom line result of any stock study. It's the thing that you use to leverage into the decision-making mode for individual or club portfolios. We are back to 2,400 companies. That's not easy because companies disappear every week. And there are a bunch of, especially ADRs, but a bunch of non-U.S. companies. If you do have a company that's in your portfolio, but it's not covered by us, send it to me. I get a couple every other day or so. And Ken, what are your thoughts on the?
Well, I just want to make your life a little tiny bit easier, Mark, and suggest to the audience that before they send you the names of companies that have no earnings of any kind, or before they send you the name of a company that was an IPO last Tuesday and they're wondering why it's not in the database right now, they need to understand that to do an analysis of the way that Manifest does an analysis, you need to have some semblance of earnings history, and you need to have some idea by the analyst community that earnings will continue in a positive way, at least for the next 4 or 5 years, so you can set some trends and set some growth patterns to base assumptions on.
Thanks, Ken. You've done this before. Yeah, in fact, I was looking the other day. Out of the 2,400 companies, there might be 5 that don't have positive earnings in 2022. That gives you some idea of how few those non-core companies are. So, yeah, that sort of thing. All right, so let's go ahead. We're going to cover this in greater detail in future sessions. I would encourage you to go back and look at some of the stuff we've done on projected return on value. And this is going to come up more and more. We'll cover it in greater detail on a couple of different companies and just kind of hammer down how to do the calculation. I do believe that in the next design iteration for manifest investing, you're going to see the projected return on value featured right on the company report pages. So that's just there to tease you. Again, we're talking about this stuff. Don't want to dig into it tonight other than to call it to your attention. If we at Manifest Investing place so much emphasis on this notion of the return forecast, if this is a representative characteristic very comparable to par, for example, it's something that we're going to pay an awful lot of attention to. Ken and I did an entire session on the subject back during the recent successful investing conference. So on YouTube, you can go back and revisit that. I just would encourage you to be warming up to this because we think it's going to take us some very interesting places. All right, I'm going to go ahead and dispense with adding to the bullish library for one more session. We've been adding books, but we're going to go ahead and skip over it tonight. I'm going to add that one next week. Just a reminder that we do have the, go to YouTube, search for Manifest Investing, and consider subscribing. By the way, that PROVE session is right there. If you want to take a closer look at it, prove it to me. And with that, I think I'm going to just go ahead and extend an invitation to the roundtable, as you've heard Ken already do a couple of times. Next Tuesday night, we close out another calendar year of investing. Something we've been doing for over 10 years and have a lot of fun doing that. All right. So with that, I'll just wish you best wishes and better investing. Have a wonderful holiday season. We will stick around for a few questions, maybe backtrack on some of those air lease questions and that sort of thing. But again, all of us, from all of us to all of you, best wishes and better investing, and have a happy holidays, everybody.
Merry Christmas, folks. Happy New Year. And stay as safe as you can until you get that vaccine.
Happy holidays, everybody.
Thanks, guys.